what the United States General Accounting Office, known as the GAO, concluded when it considered taxing cash value buildup in life insurance. By the end of this educational video episode, you will understand that taxing life insurance would cost the government far more than it would make them. You'll understand why next. So, I'm Doug Andrew. I've been doing this. What's this? Helping people optimize assets, minimize tax, empower their authentic wealth for how long? North of 48 years. And I've loved helping people do this. And if you have watched very many educational episodes on this very channel or read any of my 12 books that I've written thus far, you'll understand that one of my favorite financial vehicles that allows people to accumulate their money totally tax-free and then be able to access that money tax-free anytime in life. You don't have to wait till you're 59 and a half or whatever. Totally tax-free. And then when you ultimately die, it transfers tax-free to your heirs, is a maximum funded indexed universal life insurance contract. But hold it, it must be structured correctly and funded properly, which unfortunately, I would say over 99% of IUL policies owned by Americans do not pass this test. It is the laser test. If it is structured correctly and funded properly, it can be deemed what I call a laser fund. LASER is an acronym that stands for Liquid Asset Safely Earning Returns. Hence, the title of a book I want to gift you at the end of this episode is called The Laser Fund. It's a 300-page book that's been flying off of our warehouse shelves. I want to gift you a copy of that 300-page book at the end of this episode, so stay with me. And if you have not subscribed to this channel, please do so. It's free, and click the little bell so you'll be notified every time I post a new educational video, which I do almost on a daily basis. Okay, so this is what the General Accountability Office or Accounting Office of the United States actually determined. The last time they actually went very, very deep into a study for months and months was back in 1990. And you may be saying, well, golly, that's a long time ago. Well, since then, they've done it off and on, but they actually printed a report, and I've always held on to this report because I remember why they did this and the conclusions they came to. So let me give you a summary of what they concluded after going through this extensive report, because it involved the House Ways and Means Committee, the Senate Finance Committee. Why were they doing this? Well, in 1990, they were trying to pass a bunch of spending bills. How unusual. Congress spending more money? Yeah. When they spend way more than they bring in, they have two choices. They either have to raise taxes or find tax revenue, or they print more money, which causes inflation. And we've seen that as of the recording of this episode turn into almost runaway inflation, okay? And so when they get hard up for tax revenue, they usually look for places that they can tax that have been sort of tax sheltered in their minds because they are oftentimes short-sighted. And so they don't understand certain things. They just have heard that money inside of life insurance is tax-free. And they go, well, that's not fair. Money in IRAs and 401ks is only tax deferred. You're going to have to pay tax on it, or investments that are tax deferred, and then you access the money out of an annuity or something, people have to pay tax. So it's not fair that life insurance is tax-free, and that's all the further they think. And so they order a multi-million or billion-dollar study to be performed over the next 6 months to a year. The last time they did that really in-depth was in 1990, and this is the summary of their report. And if you were to go through and look at their conclusions, you would roll your eyes as you look at the report and what they issued to Congress and the recommendations, because they came very, very close to messing up one of the most incredible tax-free vehicles in America, where people are just trying to be responsible and accountable and take ownership of their future and not have to rely on the government for welfare, retirement, and so forth, or if they die due to an illness or whatever, they don't want their widows and orphans to be drains on society and having welfare from the government. This is why life insurance has been tax-free for over a century. In one form or another, the current 3 sections of the Internal Revenue Code are Section 72E that says money inside of a life insurance policy, when you put money in, will grow tax-free. Section 7702 says if you want to access money for living benefits or retirement income while you're still alive, it tells you how you can access money tax-free and not have to pay tax on it. So you won't outlive your money. And if you do it right, it'll knock the socks off of an IRA or 401k, which you have to pay tax on. And then at the end of the day, when you finally pass away, the money blossoms, increases in value, and transfers out into a tax-free life insurance death benefit, which is totally tax-free under Section 101A of the Internal Revenue Code. There's only one vehicle in the Internal Revenue Code that does what I just said. Accumulate your money tax-free, allows you to access the money tax-free, including all the gain, and when you ultimately die, it blossoms and transfers tax-free. Nothing else does that. So when they go to look for tax revenue, many times they'll say, maybe we should tax this little plum over here. There's trillions sitting over here in life insurance. Now, this is what they did in 1990. And they went through and had all kinds of different objectives as they studied, should we do this? So, what is inside buildup was the first part of the report. Well, that's cash value. That's money that's growing inside of a life insurance policy. So they went in and they attempted to define what is this cash value buildup. And then they talked about why it has had favorable tax treatment and why that encourages people to save and so forth. And they try to give 2 different views. And they say, well, it does encourage people to save because it's tax-free. Otherwise, they may not save. And they're taking ownership for their future. So that's a positive. But then the chapter 4 in this report is the inside buildup debate. Well, what's the debate? Well, that's not fair. How come it's tax-free? We could tax that and get billions of dollars of tax revenue to fund the Green New Deal. Or we could do this, or we could do that. And they think it's unfair. And so they have this debate. Let's start taxing this because that's unfair for people to get tax-free accumulation. Really? Why? And so it becomes this debate, and then they go through and they have all these tables and calculations, and then they end up with a conclusion. So I'm going to give you a summary of what came out in 1990, because frankly, I was nervous back then. I started in 1974, and this was a big deal. Because in the 1980s, in 1982, under the Tax Equity Fiscal Responsibility Act, which is called TEFRA, and in 1984 under the Deficit Reduction Act, it talked about the minimum amount of insurance you had to put on one of these policies in order for it to still be tax-free under Section 72E and 7702. And then in 1988, June 21st, the Technical and Miscellaneous Revenue Act, that's the acronym TAMRA, said, well, they'll only be tax-free when you need to access money tax-free if you fund it over 5 years or so. And so they had all these hoops you had to jump through, but people still did it, as ridiculous as it was, because it was far better than an IRA or 401k, and people wanted to take ownership. They didn't want to rely on the government to provide for themselves if they ran out of money, which they would run out of if they had their money in traditional IRAs or 401ks in the market, because the stock market says you only take 4% a year in a payout. On $1 million, that's only $40,000. You pay tax of 25%, $10,000. You only net $30,000 on $1 million. These can generate like $90,000 a year tax-free income, which is 3 times as much money. So you won't outlive your money with inflation and everything else. And so they said, that's why they've been tax-free. But you know what? Let's make things fair. Let's level the playing field and make these inferior like IRAs or 401ks. They don't say it that way. But this is where they begin to say, maybe we should tax these because we need the money. Now, in this report, after analyzing all of it, they said, well, if we don't tax the inside buildup, the cash value, we definitely ought to tax when people access money while they're alive. And they do it by using these tax-free loans. Now, you take it out the smart way by borrowing the equivalent of your interest, because when you do that, the loan is not due and payable during your lifetime, but loan proceeds are not deemed earned passive or portfolio income. When you borrow money for a car or for a house, you don't have to pay tax on that. So when you borrow money out of your life insurance policy, what's collateralizing that loan? The cash you left in there that you could have withdrawn. If you have $1 million in there earning 10%, you could withdraw $100,000. But after you recover your basis, that would be dumb because you have to start paying tax. The IRS actually said, you know what, if you call it a loan, it's tax-free. So you borrow the equivalent of your interest, but the insurance company keeps crediting you interest on that collateral. And you can borrow it out at 2%, and they credit you 2% on that. And that's called a zero-wash loan, but it's tax-free. Or they can charge you maybe 4%, and they'll keep crediting you 8, 9, 10, maybe some years, 25%. That's the way most savvy people take out money out of their insurance policies. And so we've had many clients who have borrowed $1 million at 4%, that's $40,000, and they earned 25% that year, $250,000, 250 minus 40, they netted $210,000 tax-free on their money while they were actually using it for their business or something. It doesn't have to be just for retirement. When they did the report, they said, well, if we're going to tax these, we definitely ought to tax those loans. Well, they're in a pickle. Why? Because what's the difference between borrowing out of a life insurance policy and borrowing for a car or for a house? Are you going to charge tax when you borrow money for a house or a car? Now they have to change the definition of what a loan is, which is a whole can of worms. And so they thought about, we'll change the definition of these kind of loans versus these kind of loans. And the final conclusion in this report, you'll be shocked. They actually said, yes, we could bring in this many $1 trillion if we taxed loans, and if we taxed the inside buildup year by year, we could also bring in this many $1 trillion of tax revenue. This could fund all of these spending bills. However, our conservative constituents on the committee pointed out that that's myopic. It's only short-sighted, because if we bring in 10 trillion in the short run, it's going to cost us 15, 20 trillion in the long run, because now you took money away from people that were trying to not outlive their money, or that you're taking away money that was going to provide for widows and orphans, and now they're going to rely on the government. And so you want to trade off 10 million today and then shell out 20 or 30 million down the road? No. And so they were smart enough in 1990 to say, leave these alone. Don't rock the boat. I can't guarantee that, because they keep wanting to entertain taxing these. But so far, so good. But there's two other conclusions that I could read between the lines. A lot of Congress people own these. They didn't want to shoot themselves in the foot. So they said, leave these alone, because this is where we put our money. The third reason, they said, if we ever do tax these, let's grandfather everybody who already has these established under previous tax law, because under the ex post facto provision of the Constitution, we're not supposed to pass new tax law that adversely affects people that establish something under previous tax law. Now, they get away with all kinds of stuff, but they were smart enough to say, if we change the rules and we start taxing these, let's just do it on new insurance policies. From the moment the legislation passes forward, let's leave everybody who owned these before tax favored. So that's called grandfathering, and that's why I tell people, you know what? If I were you, I would set these up sooner than later, just in case Congress gets stupid, they get greedy, and they only get myopic. You want to be grandfathered to be able to put money in and have it be tax-free the rest of your life. So that is the beauty behind this, and I would recommend that you learn about how to structure a max-funded insurance contract. The best way is to claim your free copy of my most recent best-selling book that I mentioned, The Laser Fund. It's actually 2 books in one. This side is 200 pages, 14 chapters, all kinds of charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip the book over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories of how a properly structured maximum funded IUL policy that would be deemed a laser fund can be used for all kinds of goals, not just retirement, but working capital for business, real estate management, emergency funds, college funding for your kids and grandkids, estate planning, on and on and on. Okay? Read both is my recommendation. Here's how you can claim your free copy. You go to laserfund.com, L-A-S-E-R, laserfund.com, click on the link below. You contribute a nominal amount towards the shipping and handling. Come on, put some skin in the game. I will pay for the book. I will fire out a hard copy to you, and there's options in there if you like to listen and learn, watch and learn. There's even a masterclass in there you can invest in if you really want to learn. But we also have educational webinars. Check out those and register. And you can even talk to an IUL specialist at absolutely no obligation, no cost, to see how these strategies may apply in your particular set of circumstances. But this is about you. It's not about me. This is about your brighter future. And the sooner you learn it and implement these strategies, the better off you will be.